You've seen it on the charts. A stock price holds steady for hours, then falls off a cliff. No news, no warning. You might think a big seller just changed their mind. The truth is often more mechanical. Someone didn't choose to sell. They were told to sell. Not by a person, but by an algorithm. On margin, you don't always pick the moment. Your broker's risk engine does. That's not a conspiracy. It's plumbing. And in a crisis, the plumbing runs the show. Think back to a volatile open. A stock you own is down hard. You're weighing your options. Hold on, buy more, maybe trim the position. But before you can decide, you get the notification. Your position is smaller, or gone entirely. You've been sold out at the low, without a phone call, without your consent. It feels personal. It feels unfair. But the machine that pulled the trigger felt nothing at all. It was just enforcing the rules of the loan you took out to amplify your bet. When you buy on margin, you enter a partnership. You bring the idea and some of the capital. Your broker brings the rest of the capital, in the form of a loan. They are now your silent, unseen partner. But their interests are not your interests. You want to maximize your return. They want to ensure their loan is safe 100% of the time. This fundamental conflict is at the heart of every margin call. Your dream of a 10-bagger is irrelevant to their need to avoid a 1% loss on their loan. Let's make the math real. In the U.S., Regulation T allows you to borrow up to 50% of a stock's purchase price. So you buy $10,000 of a stock with $5,000 of your own cash and a $5,000 loan. You're 2-to-1 levered. If the stock goes up 10%, its value is now $11,000. The loan is still $5,000. Your equity is now $6,000. A 10% asset gain gave you a 20% gain on your capital. This is the siren song of leverage. But the math works just as powerfully in reverse. If that stock falls 10%, its value is $9,000. The loan is still $5,000. Your equity has fallen to $4,000. A 10% asset drop just handed you a 20% loss. It gets worse. Your broker won't let your equity fall to zero. They have a floor. Regulators require a maintenance margin of at least 25% of the total investment value, but your broker sets their own higher house margin, often 30, 35, or even 40%. In our example, at a value of $9,000, a 35% maintenance requirement means your equity must be at least $3,150. Your equity is $4,000, so you're safe, for now. But if the stock drops another 10%, its value is $8,000. The maintenance required is now $2,800. You still owe $5,000. Your equity is now only $3,000. You are perilously close to that tripwire. One more bad tick, and the alarms go off. When you opened your account, you signed a customer agreement. Buried in the legal language is a clause that gives your broker absolute power in a margin event. It says they can sell your securities at any time without prior notice to satisfy a margin call. It says they, not you, can choose which securities to sell. It also says they can raise their house margin requirements whenever they want, especially during periods of high volatility. This isn't just fine print, it is the operating manual for how you lose control of your own account. So what pulls the trigger? A sophisticated piece of software called a risk engine. It monitors your portfolio in real time. It doesn't just look at your maintenance margin level. Prime brokers, who service large funds, use more complex tools. They run intraday stress tests. They calculate a value at risk, or VAR. In simple terms, VAR is a statistical guess of how much you could lose on a bad day. When volatility spikes, that VAR number explodes. The engine doesn't wait for your margin level to be breached. It sees the probability of a breach has gone up, and it can trigger a call for more collateral, or a forced liquidation, right there and then. When the liquidation algorithm kicks in, it has one job: reduce the broker's risk as quickly and efficiently as possible. It isn't trying to optimize your tax bill or preserve your favorite long-term holding. Often, the algorithm is programmed to sell the most liquid assets first: your big, stable index ETFs, your blue-chip stocks. Why? Because they can be sold in large size without moving the price too much. The perverse result is that the first round of forced selling can actually make your remaining portfolio riskier. You're left holding the less liquid, more volatile stocks that caused the problem in the first place. This process also explains why sell-offs can feel so strange. You'll see prices hit an air pocket, a sudden drop where buyers seem to vanish. It's because two clients with the exact same portfolio can be liquidated at completely different times and prices. Broker A might have a house margin of 40% and a sensitive VAR model. They force sell their clients at 9:35 a.m. Broker B has a 35% margin and gives clients 2 hours to meet a call. Their liquidations might not hit the market until 2 p.m. These staggered waves of non-economic selling are driven by different broker clocks, creating an unpredictable, chaotic environment. To see this in action, look at the collapse of Archegos Capital Management in March 2021. Archegos wasn't a hedge fund, it was a family office, so it had less disclosure. It built enormous, concentrated positions in a handful of stocks, like Viacom CBS and Discovery. But it didn't buy the stocks directly. It used a derivative called a total return swap with multiple prime brokers: Goldman Sachs, Morgan Stanley, Credit Suisse, Nomura. The brokers bought the stock and promised to pay Archegos the return. This meant Archegos got massive leverage, estimated at 5 to 10 times its capital. And critically, no single broker could see the firm's total exposure. Each saw their own piece, unaware they were all standing on the same crowded side of a very big boat. When Viacom CBS announced a secondary offering, its stock price dipped. This was the trigger. Margin calls went out from all the brokers at once. Archegos couldn't meet them. What happened next was a masterclass in risk management, and the lack of it. Morgan Stanley and Goldman Sachs acted ruthlessly. They held a conference call with the other brokers to try and coordinate an orderly unwind. When that failed, they immediately started liquidating their positions in huge block trades before the market opened and overnight. They got out first. Credit Suisse and Nomura hesitated, perhaps hoping the stocks would recover or wanting to maintain a client relationship. It was a fatal delay. By the time they started selling, the secret was out, prices had collapsed, and they were left holding the bag. The final tally? Over $10 billion in bank losses, with Credit Suisse losing $5.5 billion alone. The fastest clocks survived. The slowest paid the price. This isn't just a story about giant funds. Think back to the COVID crash in March 2020. As the market plunged, volatility went vertical. In response, several major retail brokers did something entirely predictable. They raised their house margin requirements. Mid-crash. An account that was perfectly fine on Friday was suddenly in a margin call on Monday morning. This is pro-cyclical risk management. The broker tightens the rules exactly when the danger is highest, which mechanically creates more forced sellers. Those new sellers push the market lower, which causes more accounts to breach the new, higher margin levels, creating even more selling. It's an amplifier, turning a steep drop into a waterfall. In the futures market, this process is even more brutal and formalized. Every position is mark-to-market daily or even intraday. You don't wait for a margin call. Gains and losses are settled in cash immediately. This is managed by a clearinghouse, which stands in the middle of every trade, guaranteeing it. In calm times, the required margin might be just 5% of a contract's value. But when volatility spikes, the clearinghouse can double or triple that requirement instantly. You get an intraday call and have an hour to wire hundreds of thousands of dollars, or your position is flattened. It's ruthless, but it's what prevents one trader's failure from taking down the entire exchange. Sometimes the plumbing gets so strained it simply breaks. In March 2022, the price of nickel on the London Metal Exchange doubled, then doubled again, spiking roughly 250% in less than 2 days. A massive short position held by a Chinese producer was being squeezed. The margin calls were astronomical, in the billions of dollars. They threatened to bankrupt not just the short seller, but the brokers who guaranteed their trades. The LME faced a death spiral. Their solution was unprecedented and hugely controversial. They suspended the market and retroactively canceled all trades that occurred during the biggest price spike. For a moment, the market ceased to exist. The exchange decided that the survival of its members was more important than the integrity of the prices on the screen. Go back to 1998 and you'll find the intellectual forerunner to all these events: long-term capital management. Run by Wall Street legends and two Nobel Prize-winning economists, LTCM was built on hubris. They used complex models for convergence trades, betting that spreads between similar securities would eventually return to their historical averages. With leverage of over 25 to 1, even tiny profits would be magnified into huge returns. But when Russia defaulted on its debt that summer, investors fled to safety, and all their carefully modeled spreads blew out instead of converging. This created a reflexive loop. Margin calls forced them to sell assets into an illiquid market. Their selling pushed prices further against them, which triggered even bigger margin calls. They were betting that history would revert to the mean. Instead, their own forced liquidations created a new, terrifying reality. Only a bailout orchestrated by the Federal Reserve prevented a complete meltdown of the financial system. This is the core mechanic of a crash: reflexivity. It's the idea that markets don't just reflect a fundamental reality, they actively create it. When forced selling begins, the price is no longer being set by investors weighing future earnings. The price is being set by a computer trying to raise a specific amount of cash. The lower price is then fed back into every other broker's risk model, lowering the value of their client's collateral and triggering new margin calls. The selling literally justifies itself, creating a cascade that only stops when the leverage is flushed out, or when a buyer with a strong enough balance sheet steps in and decides the panic has gone too far. Here's a final twist many investors miss. Your margin loan isn't just secured by the one stock you bought with it. It's typically secured by your entire portfolio. It's called cross-collateralization. This means if you have a speculative, leveraged position in one corner of your account that blows up, your broker can and will sell your safe, unleveraged, long-term holdings to cover the deficit. Your blue-chip stocks, your government bonds. They don't care about your asset allocation strategy. They see your account as one big pool of collateral for their loan. A fire in the basement can give them the right to sell the furniture in the attic. Archegos in equities, LTCM in bonds, the nickel market in commodities, the Swiss franc in currencies. March 2020 for everyone. The names and assets change, but the pattern is identical. Leverage amplifies a shock. Risk models tighten pro-cyclically. Forced selling begins. The liquidations create their own reality, pushing prices to levels that fundamentals can't explain. The outcome for any single investor is determined not just by their positions, but by their broker's balance sheet, risk tolerance, and speed. In a crisis, the market is not a collection of opinions. It's a network of interconnected balance sheets. So what's the ultimate implication? It's this. In a leverage deleveraging, the person setting the price at the absolute low is not a pessimistic investor. It's not someone with a deep insight into the company's future. The marginal seller, the one whose trade prints at the bottom, is often a machine, an algorithm liquidating an account to meet a collateral requirement. It is the most inelastic, price-insensitive seller imaginable. It is not selling because it wants to. It is selling because it has to, right now. That is why crashes are not smooth declines. They are violent, mechanical purges of leverage from the system. This is Tickerlore, how markets really work, from bubbles to blow-ups to the quiet rules in the background. If understanding the machine behind the ticker helps you make sense of it all, subscribe for more. We have explainers on everything from bank runs to how index funds changed the game. Thanks for watching, and see you next time.